Hello everybody, welcome to another video. Today we are going to be talking about interest on car loans. So before we can start with the interest on car loans, I just want to break down the difference between the repo rate and prime lending rate. So firstly, let's start with the repo rate. The repo rate is the rate at which a reserve bank lends money to the commercial banks or financial institution, which is your Capitec, FNB, Netbank, or any financial institution. So the current repo rate is 8.25. So which means Capitec goes to the reserve bank and they ask a large amount of money, which the reserve bank is going to charge them 8.25. And then when they get to their bank, the Capitec or any financial institution, when they get to their bank, when you come and say, I want a loan to go and buy the car, they add 3.5 interest on that repo rate to get to the prime lending rate. The current repo rate is 8.25. And then the banks, they charge also 3.5 as their interest. So now, which means when you add the repo rate of 8.5 and the 3.5 that the banks also add on that repo rate, it amounts to 11.75. So that 11.75 is the prime lending rate, is the rate at which the banks lend you money and they're going to charge you those interests. So now the 11.75 is just the reference point. It depends on your credit score. So if your credit score it's very bad, they can charge you more than 11.75. The 11.75, the prime lending rate, is just the interest or the reference point where they start the negotiations. If your credit score is bad, they can charge you even 15% interest. So I just wanted you to understand that. And also we need to talk about the fixed and the variable interest. So the fixed interest, it's whereby you choose when you're buying a car that I want fixed interest, which means no matter how crazy or how bad the repo rate can increase, it's not going to affect your monthly car installment. Which means if you're going to pay your car for 4,000 for 7 years or for 6 years, it will remain as 4,000. No matter if it drops the repo rate or if it goes up the repo rate, your monthly installment will remain constant. It will never change. But with your variable interest, it's whereby if the repo rate goes up, which means also your monthly installments will go up. If you are paying 5,000 per month for a period of 6 years, if in that period of 6 years, on the second year of paying that monthly installment, then the repo rate drops to a certain amount. So which means you're no longer going to be paying 5,000, you'll pay less than that. You can even pay 4.5 or 4.2. It depends on how much the repo rate has dropped. But if it happens that the repo rate goes up and then you were paying 5,000 your monthly installment, which means now your monthly installment will go up to 6,000 or 6.5. It depends on the repo rate. So that is what I wanted to share with you. Make sure that you comment, you like, share, and subscribe. Thank you very much for watching. I'll see you next time.